The only thing going faster than the driver in the lane next to you is the price increases for insuring your car. In January alone, auto insurance rates increased by 1.4, reaching a staggering 20.6 growth over the past year, as reported by federal inflation data. Remarkably, auto insurance inflation has surpassed the rates of other categories tracked by the government, such as food, energy, clothing, new and used cars, medical services, and rent. This surge continues, persisting at more than twice the rate of any other inflation category. It's noteworthy that despite the gradual decline in the overall inflation rate toward the Federal Reserve's target, auto insurance inflation remains notably high. Let's dive into today's video.
Later, the reason car insurance rates go up is because the cost to repair a car goes up and the cost for medical care goes up. When that happens, the insurance companies actually have to file with state regulators to get approval to raise their rates. And it can take over a year for the regulators to then approve those raising of rates. So by the time the rates get raised, the other factors have maybe leveled out, but you're still going to have some elements of costs that are going to continue to climb for some period of time after you get the core engine tuned down. So these are the sorts of things that I think we're seeing in the current CPI data.
I think the thing with inflation that is worth noting is that a couple of things are true at the same time, which I think is interesting. I think we were the ones in May of 21 that started getting very antsy around inflation, and we started to look at the 5 and 10 year break evens. Do you guys remember that? We would look at that chart a lot, and I think it was very predictive. We also used to look at the future oil curve. Not that we're macroeconomists, but I think it's useful if average everyday people can have a few things to look at. If you look at those things today, it tells you the same picture, which is inflation has cooled. We're going through the last kind of like throes of some of the random variables still being a little sticky, but the broad trend is down. I think it's indisputable. At the same time, even with the conflagrations in the Middle East, if you look at what people think about the future price of oil, it's also down. Oil futures are, I think, about 5 to 10%. Future prices are about 5 to 10% lower than spot right now, for whatever that's worth. But the third thing, which I think is important, is we've now started to see folks come back from the new year and start to affect some pretty big layoffs, and they're across industries, right? So what does all of this mean? It's that I think that people expect that as inflation contracts, the money supply will expand, but demand has yet to reset properly. So that's the last thing. And I think Freeberg's mentioned this a bunch. Consumer spending has always been crazy, people living on credit, all of this stuff. That is now finally, I think, the last thing that has to get sorted out. So in the absence of demand, back to the way you started, Jason, companies will cut expenses in order to maintain profitability because they don't really want to cut prices unless their product really sucks.
Yeah, and just to note that Citigroup, as you mentioned, 20,000 cuts by 2026. Google also laid off hundreds of people. Amazon, hundreds of people. Discord laid off 17%. And there's a viral video going around of a woman laid off by Cloudflare, who was only on the team for like 6 months or something, or 5 months. And it does seem like, firing people before the holidays, laying them off is considered, you don't do it in the fourth quarter. So maybe there was some backed up layoffs that people decided to do into this year. But it certainly feels like sacks.
What caught my attention here is the connection to the CPI data. It seems we're witnessing the lingering effects of an overheated or overstimulated economy. This isn't just limited to car insurance. Various elements will continue to impact our economy. However, there's a twist. As inflation contracts, the money supply is expected to expand, but demand hasn't reset properly. People are still living on credit, and the last piece of the puzzle is consumer spending. Until demand adjusts, companies may resort to cutting expenses, leading to layoffs. And speaking of layoffs, we've seen big players like Citigroup, Google, Amazon, and Discord making significant cuts. My prediction for the year was a bumpy landing, and recent events seem to support that outlook. The soft landing isn't guaranteed, and the stock market rally in latest advice, one might have been too much too soon.
People are, and you said this, I think, in the predictions episode or the recap episode, hey, maybe it's still going to be a little bit of turbulence and the soft landing isn't guaranteed. Maybe you could expand on that.
Yeah, my prediction for the year was bumpy landing. I thought soft landing was a little too optimistic, and I also thought that this big stock market rally that we had in November, December was too much too soon.
We haven't been at a level this low in the Strategic Petroleum Reserve since 1983. And so there's not a lot of levers for the government to intervene to support the supply, as there may have been in the last couple of years, in the case of some supply shock because of a conflict that arises in a major oil-producing region.
Now, let's touch on the SPAR. It's at its lowest since 1983, and there are concerns about intervention levers if a major conflict arises in an oil-producing region. The chart showing the depletion of the SPR last year is eye-opening, and the implications for a potential crisis are worrisome. In conclusion, the economic landscape is complex, and we need to keep a close eye on these interconnected factors.
It's a really interesting chart, isn't it? Because that was after the oil crisis of the 70s, and you look at how long it took to build it up and how large we built it. It's a really fast. I've never seen that chart before, but if you look at the, I don't know if you guys remember the oil lines. Did you have them in Canada, Chamath? I remember in Brooklyn, you had an even number or odd number license plate thing. If you wanted to get gas, some days was the even number, some days was the odd number. I remember my parents getting online for gas and waiting for 2 hours or 3 hours to get gas.
Yeah, by the way, I'll say this is not a real cost today that we're experiencing, but as Sachs is pointing out, there's a number of ways that this can become a real cost. I was in Austin this week, and the thing that shocked me the most was how cheap gas was at the gas station. You can get gas for like $2.25 a gallon. Pretty awesome.
It's like $6 when you're in Lake Tahoe.
Yeah.
Just so everyone understands how the SPR got depleted, last year when inflation was the top story, on the front page of every newspaper, and gas prices were hitting, $7 or $8, the administration started releasing crude from the SPR to try and bring the price down. And they did that for about a year, and they were basically subsidizing the price of oil. Now, that's why our stockpile is low. And that was a really great political strategy. But if we end up in a real crisis, we're going to have less dry powder to deal with it. So, we could have a perfect storm of things coming together here where at precisely the time we end up getting involved in a big war in the Middle East, our tools to mitigate the oil shock that would create have been reduced by what the administration's done over the past year.
Isn't the SPR designed so that when we have an economic crisis like this to use it? It's...
Yeah, the Biden administration does a lot to dip in. By the way, you have to give credit to the Biden administration in one form. It's not necessarily skill per se, but when you look at the SPR depletion, they were selling at incredible moments in the market. And the Energy Department, I think they just announced that they're buying another, $4 or $8 billion to replenish the SPR. So they'll be doing that now. But they were selling, if you look at these price points here, they were selling when prices were $80 and $90 a barrel, and now they're buying it back at $70.
It's a dynamic situation, and I'm sure we'll have more to discuss in the coming weeks. Happy investing. Until next time.